Do you know how to calculate depreciation?
Yes, let's dive into it. First, let's discuss some theory. Depreciation is an expense. This means it increases on the debit side and decreases on the credit side. Oxford Dictionary describes depreciation as a reduction in the value of an asset over time due to wear and tear. Now, the question is, how do we calculate it?
There are two methods we use to calculate depreciation: the straight line method and the diminishing balance method. Now, we will discuss the straight line method. The straight line method reduces the value of an asset in equal amounts every year, resulting in the same depreciation expense. When calculating depreciation using the straight line method, you identify the cost price of the asset, the rate of depreciation, and the amount of months the asset was in your possession. After identifying these elements, it's time to do the calculation. The depreciation expense will be the cost price multiplied by the depreciation rate multiplied by the months of possession.
Let's do a simple example. On the 1st of September 2024, N Traders purchased the delivery vehicle for 170,000 Rand. The business depreciates vehicles at 20% per annum using the straight line method. Calculate the depreciation for the financial year ending 28 February 2025.
Step 1. Identify the cost price. In the scenario, we can see that the cost price is 170,000 Rand. Step 2. Identify the depreciation rate. We can see that the rate is 20%. Step 3. Count the number of months the vehicle was in your possession. The number of months from 1 September 2024 to 28 February 2025 is 6 months for the year. Now let's do the calculation. Depreciation is equal to 170,000 multiplied by 20% multiplied by 6 over 12. The 6 over 12 indicates the months of possession for the year. This is equal to 17,000. There you have it. Depreciation according to the straight line method is as simple as following the 3 steps. The most important part of the calculation is to count the months accurately.
Now that the straight line method has been explained in detail, we'll have a look at how the diminished balance method works. Firstly, the diminished balance method can be defined as an approach that applies a fixed depreciation rate to an asset's declining book value each year. So, when answering a question, you'll need to identify your cost price, cumulative depreciation, fixed percentage rate, and also how long you've had your assets in your possession.
Now, let us look at an example. On the 1st of March 2024, Import Traders purchased equipment for 120,000 Rand. The business depreciates equipment at 15% per annum using the diminishing balance method. Calculate the depreciation amount for the financial year ended 30 June 2025.
We have been given a cost price of 120,000 Rand, a rate of 15%, but we have not been given an accumulated depreciation for the year. So, we'll start off by calculating the accumulated depreciation for the 2024 financial period. Before we start with our calculation, we need to identify when the financial year starts and when it ends. The financial year started on the 1st of July 2023 and ended on the 30th of June 2024, meaning that we had purchased goods for 4 months. So now, to calculate the depreciation for the financial year ended 2024, we take the 120,000 multiplied by the 15% and multiplied by 4 over 12, as we only had the equipment for 4 months, which gives us a depreciation amount of 6,000. Now, to calculate the depreciation for the year ended 2025, we take the 120,000 minus the accumulated depreciation of 6,000 to get 114,000. Then, we take our 114,000 multiplied by 15% times 12 over 12 because we had equipment for the full year, which gives us a final depreciation amount for the year ended 2025 of 17,100.
And that matrix is how you calculate depreciation.